All right, guys, I'm talking to Kanwal Sarai, founder of simplyinvesting.com. We are going through the 12 rules you need to follow before buying dividend stocks. Kanwal, thanks for being here. Let's start with rule number one. It is business understanding.
I'm happy to be here. Let's get started. Rule number one is, do you understand how the company is making money? If not, skip it, move on to something else. Now, it's important that we mention this right up front. The 12 rules are designed to lower your risk, maximize your returns, and keep things simple, right? We don't want people investing in the wrong companies or investing when the price is too high. And we want to make sure that as dividend investors, we're getting stable, reliable dividend income that continues to grow every year. So I've designed these 12 rules. I've been using them myself for over 25 years now as a dividend investor. And so what I tell everyone is, especially for beginners, you want to make sure that a company passes all of the 12 rules before you invest in it. So if it fails one, skip it, move on to something else. Okay, so back to rule number one. We want to keep it simple. You want to be able to describe, how does Walmart make money? So let me ask you that question. Can you tell that to the audience?
Walmart makes money by selling stuff in their stores or online. They have really great margins, so they buy stuff in bulk so they can sell it for cheaper. They don't pay their employees too much, so they keep costs low there. They expand really quickly, so a bunch of stuff. But yeah, simply they sell stuff for cheap because they buy it in bulk. Really quick, I've noticed 80% of you who watch these videos haven't subscribed. An easy way to support this channel for free is to hit that subscribe button. It not only helps this channel grow, but lets me know you want to see more content like this.
That's right. Absolutely. Right. They're buying products at wholesale and then selling them at retail prices, and they mark up the prices. Right.
Yes.
So that's perfect. You got to be able to explain it to your grandmother what a company is doing. So that's fantastic. Right.
I was like, all right, I hope I better know how Walmart makes money, and I run an investing channel. But yeah, let's talk a bit about that. Do you think that's a common thing then? We're going to dissect this a bit here. So that's a common thing, right? So people, when they're buying a stock, is it because they're just hearing stuff online? They're hearing a bunch of talk, like this is popular, and they're like, we should get on it, but they have no idea what that stock is.
Absolutely. This is what gets people in trouble, right? And the internet makes it worse. TikTok makes it worse. Social media makes it worse. People will watch, I've seen TikTok videos where somebody's going to give a 30-second video clip, and they don't even tell you what the name of the company is. They're just giving you the ticker symbol. And they're saying it's going to blow up, the price is going to triple, it's gone up already 200%. You should just go out and buy it. And that is absolutely the wrong approach. If you're just going to go out and buy a company based on a TikTok video or a YouTube short, just on the stock symbol, and you don't even know what the company is, what the company name is, and what the company does, skip it. That's too much risk, right? You're just taking on too much risk there.
So that's the test then. If you can't explain it in like one or two sentences really simply to your grandma, we were talking off camera, we're both Punjabis, we have Punjabi grandmas. How would we explain it to our nannies and stuff? Like, how would we explain it to them? All right, I say it in Punjabi, but I'd say what I said more or less. Talking about that though, like when people make impulsive decisions, they're buying stuff off of sentiment there. Is there also a risk of, okay, maybe they feel like they understand it, but it is too hard to explain. The business model is too complicated. Is that another red flag of like, wait a second, what exactly? Like, I think like, you know, those companies you're talking about, we're like, okay, I think this is how they do it. You think you have a grasp, but you have to do a pause. Is that a red flag?
That is a red flag. It is, right? Because then how is the company making money? How are they profitable? Because if they're not profitable, the stock price isn't going to go anywhere. And if they're not profitable, they're not going to be able to pay you a dividend, right? So absolutely, that's a red flag. And this doesn't mean, just skip it. Do your research. Look it up. Go to the company's website. They have an investors page. Look it up. You can use ChatGPT now. You can use Wikipedia. Tons of resources out there. Get an understanding of what the company is doing. What are the products and services that they're selling? And that way you can, like I said, explain it to your grandmother. And that's it. You don't need to spend weeks and weeks and months trying to research in depth on how the company is making money. You should be able to figure it out relatively quickly.
I feel like we're only on step 1 of 12, but I feel like step 1 or rule 1 is going to weed out a lot of bad decisions. Because now that someone's going to do that, being like, wait a second, that was really hard to explain, or I don't immediately understand. Maybe just move on to something else. Go find another company. There's so many companies. Just move on to the one that's simpler and easier to understand. All right, let's go to rule number 2, long-term viability. 20 years from now, will people still need its products or services? Rule number 1 and 2, those are my foundational rules too. Let's dive into rule number 2 and why is it so important?
Yeah, absolutely. Now, look, we're investing our hard-earned money into these stocks, whether it's in a TFSA, RSP, or if you're in the US, a 401k or an IRA, or even a non-registered account. This is your hard-earned money. You're investing it for your future, and you want that money to grow. And you want to make sure that when you're investing in a company, that the company's going to be around for a very long time. We're long-term investors, by the way, right? I'm
Mhm.
not going to tell you, I don't invest in crypto. I don't invest in, I don't do day trading. I don't do any of that stuff, right? I'm a long-term investor. So I want to make sure that the money that I'm investing today, that the company's still going to be around 10, 15, 20, 30, 40, 50 years from now, right? And so rule number 2 is it helps us to avoid fads, like something that's, it's hip right now. Everybody's talking about it. They all think it's going to be the next big thing. Is it going to be around for the next 20 years? I don't know, right? But there are things that will be around for a very long time that people will still need those products and services.
Yeah, you avoid 6 a.m. panic when sentiment changes on a fad stock going, oh my God, everyone just sold. That doesn't happen when you buy a Walmart or a Coca-Cola. It's just stable, other than like hikes and price, like sometimes, but for the most part, it's just like this, where you could buy it and forget you own it for 10 years and come back and be like, oh yeah, that thing that's been paying me dividends for X amount of time. But when you buy the fad stocks, that's probably why I avoid them, is it's tempting first off when you're like, oh my God, like you'll see a fad stock go up by 400% or something crazy and everyone's talking about it. But it's more like if I miss that window to sell, it's first off, it's just like, oh my God, I'm on the tail end. I'm the loser on the tail end where everyone's laughing to the bank, where I'm like, I think GameStop is at some points. I don't know, like some point, I don't know, within the last 12 months, I've been told buy GameStop, that guy, the kitty, roaring kitty, had some news. It spiked up. I was like, I'm not buying that. Like, I'm telling you right now, he's not going to give out any news. And before he does, they're probably going to like stop trading on it. And when they open up trading, everyone's going to sell. I'm like, I just described what was going to happen because it's a fad stock. Exact scenario happened. So if I would have bought and if I wasn't timing it up perfectly, I would have lost everything that I put into it. So it avoids that stress. And I think for most people who are investors, I think a lot of people who watch this channel aren't full-time investors. They have full-time jobs, they have families. They're not staring at the stock chart. They're not timing out these trades where if you have a fad stock and you want to be profitable, you got to do that kind of stuff. Because if you're off by a few hours, you lose your money. And that's stressful. That's just not good long-term. It feels more like gambling than investing,
Yeah,
I suppose.
absolutely. Yeah, and you want to be able to sleep at night, right? And
Yeah.
if it's going to stress you out, and like GameStop is a perfect example, is a meme stock, right? A
Yeah.
meme is popular for a little bit of time, a short period of time, stock blows up. Like you said, they go up 400, 500%. They go down just as easily, 400, 500%. So you want to minimize your risk and you want to be able to sleep at night.
All right. Now let's move to rule number 3. I like this one. I'm reading through this rule sort of with you, and I haven't like researched your rules too heavily. So as I'm reading it, I'm going, oh, that's really good because it's real time reaction to like, oh, I like this rule because these are all sort of hitting my same criteria. Rule number 3, competitive advantage. Another one of the fundamental things I look for before I buy a long term hold. Does the company have low cost competitive advantage? Let's talk about that. That's a great one as well.
Yeah, absolutely. So this is, I'm going to use Warren Buffett's example because it's a
Yeah.
perfect example. I can't make it any better. So let's just use his example. So think about a company, a corporation as a castle. And around the castle, there's going to be a moat. The deeper the moat, the wider the moat, the better the company is going to be able to keep competitors away. So let's
Yeah.
take an example of Coca-Cola. This is a company that operates in over 100 countries. They've been around for more than 100 years. And you can take that logo anywhere in the world and show it to somebody in any language, and they will know you're talking about Coca-Cola soft drink. And now, of course, they do beverages. They're into orange juice and bottled water and all sorts of other snacks and things that you would drink, right? So Coca-Cola is such a large brand. they have a low cost competitive advantage because they've been around for a very long time. They're all over the world, and they have, I haven't looked at the numbers, but I think between them and Pepsi, they've got sort of the majority of the
Yeah,
market share
they have everything. Yeah. Yeah.
worldwide, right?
Yeah.
So if you were starting a company today to compete with Coca-Cola head on, you would have to spend billions and billions of dollars in marketing and advertising, and you still wouldn't get to where they are today. Maybe you would in
Mhm.
20, 30, 50 years, but not next year or the year after that. Coca-Cola is still ahead of you because they have that low cost competitive advantage. And the other example, very quickly, is going to be McDonald's, right?
Mhm.
People will cross the street to go to the McDonald's, even though there's a burger shop closer to them. Because if you want a Big Mac, there's only one company in the world that can give you a Big Mac today, and that's McDonald's. So there's also brand loyalty that gives them that low cost advantage as well.
Okay, so two things popped in my head when you said Coca-Cola and McDonald's, and there's another thing. I'm going to talk about tech stocks and competitive advantages. I want to go into that because I own a lot of tech stocks. Actually, I sold off a lot over the last couple of months, and I have a video about that that'll come up before this one, so people know that I did that. But for Coca-Cola and McDonald's, they have a competitive advantage. They also, I guess, this competitive advantage, they have an emotional and psychological advantage on their consumer base. This is one of my favorite things to talk about. So I'm always looking for companies that have a psychological hold on their clientele. I'll quickly summarize this. My wife loves Dollarama and dollar stores. She'll go to them all the time. We're well off, but she still likes going to them. Dollarama has a psychological hold on its base. People just who shop there like shopping there regardless of income level because it has a hold on them. It's a feel good thing. She does it to stress relief. McDonald's brings you back to your happy childhood, a happy meal, going there for even a cheeseburger or something. There's actually an emotional attachment. Coca-Cola, emotional. I'm thinking of a hot day, cold Coca-Cola. What's better than that? Oh, it's Christmas time. You got some polar bears. You got Santa Claus. You got a cold. Everything I described is an emotional feeling. Dollarama, emotional stress relief. Go in there, $20, feel like a millionaire. Coca-Cola, feel great, relax. McDonald's, happiness, childhood. Emotional. That's a competitive moat right there as well. And that's the branding, and that's from years of branding. That's something I look for. It's one of my top things I look for when I do long-term investing. But when it comes to tech stocks, I think I would have felt like some tech stocks had competitive moats built around them 5 years ago. I would have said Google. I would have said Microsoft. I would say like Microsoft owns the corporate industry. I said Google owns all search. But I feel like with tech, and I'm a tech guy, there is no such thing anymore. It's going so fast. The AI race is going so fast. Nobody knows what the landscape looks like in 5 years. I know until my whole generation will always have an emotional attachment to McDonald's. And McDonald's does a good job of brainwashing a new generation with their Happy Meals, right? Coca-Cola, my generation and new generations. Dollarama, still going strong. Tech, tech adopters adopt new technology and go, whoop, on to the next thing, on to the next thing. There's no emotion. I'm the Google ecosystem, but I don't get emotional about Google. So if something better comes out, I'd be like, I guess I'm switching over because it's cheaper, better, more reliable. Do you feel, that was a bit of a tangent, do you feel like in the tech space, am I accurate about that assumption? Or do you feel like there are companies out there that still truly have some level of competitive advantage, have a moat, as you said?
Yeah, so I agree with you. For example, take a look at the cell phones. You've got a Samsung or an LG. There isn't too much brand loyalty there. People are going to go
Yeah.
with the fastest cell smartphone, the one that's got the most storage, memory, better screen, better sound, and between them they'll sort of flip back and forth. The one exception I think is going to be Apple. I've got a couple of buddies who are Apple loyal fans. They will not get rid of their iPhone. They will, when they upgrade to another iPhone. I've shown them Android phones, and I'm like, look at this, it's a better screen, all this stuff. And they're like, no. So I think Apple is the exception there, but generally I agree with you. When it comes to tech stocks, there is not enough brand loyalty there, and people will switch.
Let me comment on Apple a bit before we move on to rule number 5. And this is where I'll probably need people in the comments to tell me where I'm wrong. I don't own Apple stock, never have. I don't have an Apple phone. I don't have an Apple PC. I'm not in their ecosystem, so I don't actually understand the products that well. So my research is just like peripheral. But from what I understand is they lock people into their ecosystems. Once you're in, it's hard to get out. And once you're in, you can only use what they have. So when you're in, you're sort of stuck. And they also don't connect with other devices outside the ecosystem very well. I use the Meta headsets and all that stuff. And Meta complains that like their earbuds, Apple earbuds don't connect properly with like Meta headsets and stuff. And they do that on purpose. Like they make everything very, very difficult to go outside of their ecosystem. So once you're in, it's like a drug dealer thing where they give you a little taste and then you're like hooked, like you can't get off. They get you in the ecosystem and then you can't quit because it's just such a pain to get outside of it. Because when you're in it, you only can use their products to efficiency, to really properly leverage all their stuff. You have to own all the Apple stuff where Google and Android doesn't do that. It's an open source or everyone uses it so that you're able to move around more. So I think they strong arm their way into that moat is what I'm saying, and it could have backfired, but it didn't. Right? People go like, oh no, that's too regimented, too strictly. But people are like, no, I guess we'll go along with it. And maybe they just got people early on in the process. They didn't know what was happening to them. And it's too late now. You have all these people built in because I couldn't imagine someone who's fully has iTunes, has Apple headphones, Apple laptop, Apple phone, and then be like, oh, now I'm going to switch to a Samsung. It's like, all your photos are stored in iCloud. You have how many tens of thousands of you would just never do it. You're like, I guess I'll just take the hit. I'll just keep using it. It just seems like too much of a headache. I think that would be it. Unless a company says, hey, we have an Apple transfer service and we'll do it for you. And all you have to do it for free. If you, that's a good business idea. There you go. But I'm saying there's always a way to destroy that moat. So that's what I'm saying. I'm saying that's how they're doing it. And that would be the solution.
Yeah.
That's my Apple tangent. Okay. Let's go on to rule number 5. It is consistent. Rule number 4, recession resilience. Is the company recession proof? Another great one. So let's talk about that.
Yeah. So this one's really easy to explain. Let me ask you a quick question. If there's a recession and there's a chance you may lose your job, are you going to go out and buy a brand new car?
Oh, no, of course not.
No.
Yeah.
No, are you going to go out on an expensive vacation overseas with your family?
No.
Probably not, right? You're going to hunker down. You're going to be like, you know what? Let's keep the car we have a little longer. Let's use public transit, or let's do a short vacation within the country. We don't need to travel outside because there's a recession, there's a market downturn, there's a chance you may lose your job, or you may have already lost your job, right? People aren't going to buy those products and services. And so for that reason alone, we don't invest in car companies. General Motors is a perfect example. They cut the dividend to 0 when COVID hit. We don't invest in airlines, again, because it's cyclical, right? Those businesses are cyclical. And we're investing for the long term. We're investing for our future. So if you've invested in car companies and airlines, and then you're 65 now, you're going to retire, you're relying on the dividend to live off of it, and we happen to be in the middle of a recession for a year, maybe 2 years, and all of those stocks have tanked, you're stuck. And that's the worst time to sell is when the stock prices are low, right? Or they've cut their dividend. So we just avoid all of those companies that are not recession proof altogether. Now, take a look at this. Even if you lost your job, you still need to brush your teeth. When you come home at night, you still got to turn the lights on, right? If you live up in Canada here in the winter, you got to heat your home, right? So there's still product and services that you still need to eat. You still will need those services, even if the market tanks.
That's a really good point. I'm just trying to think of, as you're saying that, I'm like, okay, what companies, you mentioned some that are recession proof. I'm trying to think of what are some that might be recession proof. It says Amazon count as kind of recession proof because during COVID, I felt like it was kind of that kind of recession because everyone was stuck inside. Is there situational recession proof? Right? Like Amazon made sense for that environment, but that's still not long term. You're expecting that environment, right? To replicate. You need something that'll replicate consistently over 30 years. So would Costco be recession? Groceries? Like I'm just thinking, okay. So it's really just, what do you need? It's actually, is this a good way to assess it? When I tell people to put together an emergency fund, I go, what are the essentials you need to survive? And then you basically go like, I need toothpaste, I need some food, I need this. And then you just go at what companies provide that. Those are recession-proof companies. Whatever my bare like, because like it cost me $3,000 to exist a month to do this. What companies provide that, right? With the exception of the car companies and stuff like that, because you're not getting new cars and all that stuff.
Yeah.
I guess that's an easier way to like break it down to be like,
Absolutely. Yeah, you can think about banking. You can think about insurance, utilities, energy
yeah,
companies. Those are things that we will continue to use even when there is a recession out there.
which is what Canada is known for essentially. So Canadian market,
Oh, yeah,
that's not too bad.
yeah, that's pretty
Hey,
good.
there you go. All right, so recession proof. Rule one, two, three, and four. Like we've weeded out so many companies now with this. You've now gone from the guy who's about to buy that penny stock to now you've gone from 1,000 stocks to like 10, which is great, which is fantastic. You've sifted through the garbage. So there's already a lot of value out of anyone who's ever, because I get a lot of people going, hey, should I buy individual stocks? How should I go about doing it? I feel like this list now takes care of that. Like it answers to that question. Like, here's how you do it. Just follow your 12 steps. Now, rule number 5, which I accidentally said before, was consistent profitability. And is the company consistently profitable? So let's just talk about that.
Yep, absolutely. So, nobody can predict the future. I can't do it. I don't know what's going to happen with the stock market next week, 6 months from now, a year from now, 5 years from now. I have no idea. Is the market going to keep going up? Are we going to get another downturn? Who knows, right? So what we need to do here is we want to make our best educated guess. And remember what I said earlier at the beginning of this episode here. We want to minimize our risk, want to maximize our gains. And so how do we do this? With rule number 5, we look for companies that have a solid track record of profitability. And so we break it up into sort of rule 5A and 5B. So
Yeah.
5A says, okay, the average EPS growth over the last 20 years should be 8% or more. If it's not, well, then the company fails rule number 5A, move on to something else. Rule number 5B is related to earnings, and we want to see at least 8 increases or more in the last 20 years. So the best way to visualize this is if you graph it, and you can go to any website there, you get stock quotes, and you can look at Yahoo Finance or Google Finance and look up a company and look at their earnings per share over the last 5 years. I like to go back 20 years. And if you graph it, of course there's going to be ups and downs. Companies will make money, then they make a little bit less, and they make overall the trend, we want to see it doing this. So for those of you listening, you can't see what I'm doing with my hand here. I'm sort of drawing a graph.
It's going up. It's going up slowly.
It's going up slowly, right? And so
Yeah.
that's what we want to see. We want to see consistent growth, because then we can have some level of confidence that next year the company will make money. It'll be a positive earnings, and hopefully it'll be more than what it did the year before, right? What you want to stay away from are companies that do this. And again, if you're listening, I'm going up, I'm going down, I'm going up, I'm down. Companies will have negative earnings. That's when they lose money. Then they make some money, then they have negative, negative again, up and down, completely random. And when I see a graph like that, I have no confidence. I don't know what's going to happen next year. Are they going to lose money?
Yeah.
Are they going to make money? So I don't want to take that risk. So that's rule number 5, is to look at the track record. If the company's been profitable, then we know that the dividend is going to be safe, because the dividend is paid out of the earnings. So that's what we look for there.
Yeah, essentially you're looking for a company where using some basic math, you could guesstimate out their revenue 20 years from now if it just keeps on along that trend line. It's basically just a trend line that it averages out to, that it'll follow. You go like, yeah, in 20 years if you just follow on this. Like they do that with the S&P 500. You kind of go like, what's a trend line? It'll probably be here in the next 30 years. If you can do something similar for whatever company you're looking at, you're in a good spot. The zigzag thing is always dangerous. There's a lot of reasons for the zigzag, but it's like you said, if you're trying to minimize risk and you're trying to have the highest reward, you don't play around with zigzags. You just increase risk and you've already broken the rule. All right. So that's rule number 5. And then we did 5A, 5B in there. Now, rule number 6 is dividend growth history. 20-year average dividend growth must be 8% or more.
Yeah, so this is going to be similar to rule number 5. We are now looking at the track record. I like to go back 20 years. And now we're looking at the dividends, because the dividends that's money in your pocket, right? When a company pays out a dividend, that's deposited as cash into your trading account. And so you can spend that money if you wish, or you can reinvest it. So whenever a company pays a dividend, that's good. When they increase the dividend, that's even better, because now you're getting paid even more than you were before. So what we look for here is, like you said, 8% or more of dividend growth over the last 20 years. All things considered equal, if you were looking at two companies, let's just say in the same industry, and one of them had dividend growth of 28% and the other one had dividend growth of 2%, which one would you invest in?
Well, the 28% growth
That's
is,
right.
yeah.
Right. I'm oversimplifying it, but that's,
Yeah.
that's what we look for. And it comes in, the rules also come in handy when you're comparing companies side by side, right? So then I could look at Coca-Cola and Pepsi and I could compare rule number 6 and say, okay, which one has higher dividend growth? And again, this is going to give us the confidence that in the future, next year, the company is going to pay a dividend because they've done so over the last 20 years, and hopefully they're going to increase it. I'll give you a really quick example with Coca-Cola. They have now had 60 plus years of consecutive dividend increases. And those are consecutive dividend increases.
Yeah, that's really
Think about
good.
how many market crashes we've had in the last 60 years, how many market downturns. We had COVID, 9/11, 2008, 2009 financial crisis. But Coca-Cola and other companies like it have not only paid a dividend, but increased it year after year.
That thing where you do a comparison of dividends, I think that's really handy if you get down. Let's say you've done rule 1, 2, 3, 4, 5, and you're like, great, I have Coca-Cola and Pepsi now on my radar. I've dwindled onto there, but I have limited capital. I got to pick one. There you go. That'll be my deciding factor. I'll just go with the one that has that. If I have to put my money in just one, you go there. So like even that's a great way if you made it this far down the list, just to determine where to put your capital. If you have limited capital, you just can't invest in everything because you just can't sometimes. All right. Let's go to rule number 7, payout ratio management. Payout ratio must be 75% or less.
Yeah, so this one is rule number 7 is we're looking for, can the company afford to pay the dividend? Now, I quickly said it earlier on, the dividend is coming from the earnings. You can't fake the dividend. The company has to pay the cash to the shareholders, right? If the company says they're paying a dividend of $1 per share, well, then the shareholders are expecting $1 of dividend per share. It has to be paid. You can't fake it. You can fudge the numbers with earnings, right? You can do share buybacks, or you can issue more shares, and that the earnings number will fluctuate. With dividends, that's cold hard cash. The company has to pay you. And so I'll give you a really quick example. Let's say a company is making earnings per share this year. They made $2 earnings per share, right? So that's how much money they made. That's how much profit they made. Out of that, they paid $1 to the shareholders as a dividend. So that's a payout ratio of 50%. And that's really good. That's a healthy payout ratio. That means the company can increase the dividend next year, maybe $1.05, $1.10. They've got room. They can go up to $1.80 if they wanted to. They could do that. But there are companies out there today, I'll just use an example without naming any names. The earnings is $2 a share, but the dividend is $3 a share. So the payout ratio is over 100%. How are they only made $2 a share, but they turned around and paid $3 a share to the shareholders as dividends. Where did the money come from? Right? So they had to borrow it from somewhere because the earnings were not enough to pay off the dividend. So if I see a payout ratio of 75% or more, that's a yellow flag. And that means the company is not going to, they're going to either have to reduce the dividend next year, or they're going to have to up their earnings. And that's a risk I'm not willing to take.
Yeah, they're doing that because they don't want to reduce their dividends. So that okay. Yeah. So they're like, okay, we have to pick one. And the smarter thing would be to reduce their dividends and just take that hit. Then basically,
but
who
the
knows where
moment
they're
they
getting
announce a dividend reduction, the stock price drops.
And then it drops too, right? They're between a rock and a hard place at that point.
Now,
right?
to be fair, some companies will do that temporarily where the payout is high, but then they finish off the year and the earnings go up and they're fine.
Yeah.
Right. But again, it's a risk I don't want to take. I'll go with a company that's got a lower payout ratio, higher chances that they're going to increase the dividend the next year.
Yeah, if they have a long-term track record of payout ratio of 75% or less, you're looking pretty good. A long-term track record. All right. All right. Rule number 9, dividend stability. Avoid companies with a
No,
recent
rule
dividend
number
yield.
8. We skipped over rule number 8.
There's a long list here. I'm
No
all over
worries.
it. Okay, rule number 8, debt management. Long-term debt equity ratio must be 70% or less.
Yes. Now, this is like I said, for most stocks, this is going to be the case. And that's the reason I put it in here. Because the whole idea with the 12 rules of simply investing is to keep it simple and for people to easily follow it. So for the majority of investors, especially if you're a beginner, follow the rules here. That's what it's for. So rule number 8 is we want to make sure that the company's debt level is manageable, right? Companies, of course, will borrow money as they need if they're doing an acquisition or they need to buy new equipment. They're going to borrow money. That's fine. I just don't want the companies borrowing too much money. I'll give you an example. Again, if you had a choice between a company that had a debt level of 10%, and there are companies out there that have a debt level of 0, which is even better.
Mm.
They're self-funding everything, right? That's fantastic. But let's just go with 10%. So a company has a debt level of 10%. All things considered equal, both companies are in the same industry. The other company has a debt level of 900%. Which one are you going to invest in?
Okay, on first glance, I'm going 10%, right? Second glance, I'm going, why did you just take 900%? Like my interest is going, whoa, what's going on here? Is it like Elon Musk is like, well, I'm building a 10,000 spaceships and we're going to Mars? And I'm going, let's do this. I believe in Mars. And it's purely a sentimental, emotional decision on my part, being like, I'm going to fund this initiative, take on all the debt, take on every loan. Let's build these rocket ships. It would have to be something so extraordinary and so fueled with expansion that could justify that level. But then at that time, I'm inherently taking on a ton of risk and I've broken the rules. And I'm in a bad position, but I'd have to justify going in. I'm taking on a ton of risk. I'm doing this because this is something philosophically I believe in, or some sort. It's a clearly an emotional decision where I just want this company to do this thing that they're dumping all this money into. But it's not an investing decision. Like I'm not an investor anymore at that point. But that's sort of what I'd look at it.
Yeah.
But I would do research into why does one have more debt than the other, and why do they need it, and if it could justify, it's the same reason why people invest in like ESG companies where they're like, we care about the environment and social governance, whatever it stands, environmental, social, and governance. I care about that. So all things equally considered, they'll do the ESG company because they have that sticker on their company, even though more or less probably it's a sticker. I might go, all right, all saying the same. One company has 10% debt, one has 13% debt. It can't be that large. I go 13% because the extra debt, I get why they're doing it because they need to do this other thing here. Like I said, maybe buy more equipment or something. It's that year, maybe it's been 20 years, they got to upgrade. It's been 10 years, they got to upgrade. It have to be some justifiable reason, but it couldn't be a drastic gap. It couldn't be like a 10 to 50%. It has to still be within range if I'm looking at them,
Yeah, absolutely.
Is that the right decision-making process I'm using there?
Yeah. For most people, the answer is I'm going to invest in a company that's got 10% debt, right?
Yeah.
Because it's low debt. Or like I said, 0 is even better. There's companies that have debt in the single digits, and there's companies that have debt in the triple digits and even 4 digits, which is crazy. Because you know what? The exception is, like you said, if Elon's going to build 100 spaceships or whatever, he needs a lot of money. But that's the exception to the rule. Most of the time, this is a high level of debt is a yellow flag. It means that there's mismanagement. The company is not able to contain its debt. And what's going to happen is when there's a market downturn or a market recession or interest rates go up and interest rates double or triple, the company is going to have a very hard time servicing that debt. And that's where we start running into problems where now they have to start laying off people. They have to start closing factories just so they could pay off their debt. And then the stock price will tumble. And the dividend is obviously one of the first things to go. And as dividend investors, I don't want to invest in a company where the dividend could get cut.
Yeah, at that point you made right there. If interest rate goes up, it becomes unmanageable, laying people off. That'd basically kill, even now, like I think about it, the 10 to 13% argument I had before. But at the same time, we're different investors. Sometimes I do invest in stuff I just believe in. If I go, right, let's hang on this a bit, and this is not quite on this. Do you ever have some level of an emotional attachment, or you believe in some company's philosophy or what they're trying to do, or is it cold hard? You see an Excel spreadsheet, you got the numbers, you got your 12 rules. It could be anything, but if it fits that criteria, boom, you're buying it. You don't care what they're doing. Or
Yeah, so
where are you?
I'm the latter. I'm just looking at the numbers and Excel
You're a
spreadsheet.
robot. You're a robot, my man.
Well, that's
Inhuman
number 12.
robot.
We're gonna get to rule number 12 in a minute.
Okay, I'm a little more human than you, but to my detriment. To my detriment. And every time I humanize my investing, I'm very aware I'm taking on risk, right? But I calculate that risk in, and I go like, okay, I'm willing to take a loss.
You
Some
got to
sort,
be
yeah.
careful. You don't want to fall in love with the company because,
Yeah,
right,
yeah,
then you could stay in love with it while it's dropping,
yeah, yeah.
right?
I've had that. I've had that with. I've had one company like that. It ended up working out for me really well, but is Unity.
Mm.
It's they're a game developer. I'll briefly talk about this. I'm in love with VR. I'm a nerd. I like to go to the metaverse and do stuff, right? So, and they're the biggest game developer, Unity. I've done advertising on you. Like Unity has an advertising backend. Well, now they merged with another company, but I know a lot. I know a lot about Unity. I bought them at a low. It got even lower. I took a loss for a year, but then they like doubled. So like I'm way up on it, but there was a point where I was like, oh, this is really dumb. I bought this only because I believe in the metaverse. Like I purely bought, and it just happens to be working out for me. But honestly, there's a lot of luck at play there because there's no reason why it should be up where it is, right? Oh well, I haven't checked it in a bit, but you know what I mean. So like I have done that, but I say 99% of my investing is closer to what you're doing, a little bit more soulless and robotic. There you go. Okay, let's go to where are we? We're at debt
Rule number 9.
management. Number 9, dividend stability. Rule number 9: avoid companies with a recent dividend cut.
Yeah. Okay.
Yeah.
So a good way to explain this is when a company announces a dividend increase. Okay. Usually they do that once a year, especially companies like Coca-Cola, Walmart, Johnson and Johnson. They've been upping dividends. Johnson & Johnson, I think, is 62 years. Procter and Gamble is now 64 years of consecutive dividend increases. So when a company announces a dividend increase, it means that they've crunched the numbers. They've got teams of finance experts and accountants within the company. They've crunched the numbers. They are confident that they will be able to pay a higher dividend next year because basically they're committing to it. When they announce a dividend increase, the expectation is that the dividend, that's what you're going to get paid because the dividends are paid quarterly, right? They announce it at sometimes beginning of the year, it's their fiscal year. So it could be whenever their fiscal year end is, they'll announce it, but then you get it paid quarterly. So when they announce a dividend increase, you're fairly confident you're going to get the higher dividend for the next quarter and the quarter after that. So that means they've done their homework. They know that they've got enough earnings and that the earnings will grow sufficiently to be able to pay the dividend. Because the last thing companies want to do is announce a dividend cut. Because as soon as they announce a dividend cut, the same day the stock price will tank. And a lot of investors will get rid of it because now all of a sudden your dividend yield, which was like at 3.5%, 4%, is now down to like 1% or 1.5%. You know, people will take their money elsewhere, put it into another stock somewhere else where they can get a higher rate. So what rule number 9 says is that if a company announces a dividend cut, that's a yellow flag. That means they've crunched the numbers. They know that they can't pay the dividend, the amount that they were paying. They're going to pay less now. What's going on? Is the business shrinking? Are they expecting less revenue? Have they run into financial trouble? It could be any number of things or all of those things. We don't know. We don't have visibility into that. Unless you work in the finance department in that company, you won't have visibility into that. So what we have visibility into is the press release that comes out and they say, hey, by the way, and General Motors did that, Boeing, Disney did that during COVID, where they said, you know what? We're not paying a dividend. We're cutting it to zero. They eliminated the dividend. And so right there, that's a yellow flag to investors. So, you know, a company could pass all of the other rules, but if we get to rule number 9 and you realize the dividend last quarter was $1 and now it's 15 cents or zero, skip it, move on to something else.
But you said yellow flag, not red flag. So is there wiggle room for you? I'm always just looking for reasons to buy. Is there wiggle room? Is there wiggle room there for you to be like, okay, because you said, well, why did they cut it? Right? What's going on here? Will you, because you're methodical in your approach, go, it is COVID, it is Disney, it makes sense. They have to do this. They're running a business here. And as soon as this gets resolved, it's going to come back on. Yeah, I'm not going to just sell it, get rid of it, and then probably eventually buy it back when everything turns. I'll just hold it. The rationale makes sense. Will you equate that? Or is it, hey, you cut it? That's a red flag for me. I might say yellow flag on the podcast, but for me, it's a red flag. How do you do that?
Yeah, so I can explain that. So if you don't own the company and you're thinking about buying it and it fails rule number 9, then don't
Yeah.
buy
Yeah, good,
it.
good. Yeah.
If you already own it, so in the case of Disney,
Yes.
some of my friends have had it for 10, 15 years. It's been paying dividends consistently. And then COVID, at the time we didn't know, but now we realize, okay, it was a one-off. It happened. The world, we recovered and got over it. And Disney has, in fact, reinstated the dividend. So the dividend did come back. So
Okay.
for those folks that own it, it's a yellow flag. You're going to have to make a judgment call. Do you want to keep it? And that's where it gets challenging because it's more of an art than science. Because if you sell it, then you're going to solidify your losses, right? Because they've already announced a dividend cut during COVID in March, and price went down. If you sell it, you're going to solidify losses. Maybe you're better off just keeping it.
Yeah, that's true too. Yeah, you're gonna realize those losses. But that is a hard one. And then it's like, imagine if you're retired and you're relying on monthly dividends, you got to replace that.
Yeah.
Could maybe you had it coming out to 1,000 a month. Now you've dropped down to 850. You need that 150 to pay for your prescriptions or whatever. Like you got to fill that. Damn it. Yeah, that's a hard one. Oh man. And that's, I think, why it's so important. This comes back to why it's so important to follow these rules so you don't fall into these problems. When you got these companies that have proven 20, 10, 20-year track records, if something bad like COVID does hit, they might be the ones still paying it out just because they're so established. You just know that you're safe, especially when you're someone who's living off these dividends in retirement. That's something to consider. I like the rationale there. It's like, if you don't own it, yeah, red flag, keep on moving because you're building out a profile to last you to long term, 20, 30 years. You don't hit problems. And if you own it, man, case by case, judgment call, but definitely a yellow flag. Yeah, that was great. We have rule number 10, share buyback activity. This is one I like this one a lot too. Does the company actively buy back its own shares?
Yeah. So what we find with some companies, so what we're getting to here, we're already at rule number 10 now. So we've got just 2 more rules left. What we're really looking at here we're filtering out a lot of the noise and we're getting laser focused on quality companies. And that's huge, right? We want to look at quality companies. And so quality companies are ones that are well managed, well run, and management knows what they're doing. And they're able to continue to grow their earnings and grow their revenue, and they spend the money wisely. They're not blowing their money on, I don't know what you would blow it on, large factories, I guess, or marble tiles if you didn't need them in the factory. I don't know, somewhere.
Yeah.
But so quality companies are companies that are run well. So what we found, and like I said, I've been doing this for 25 years. There are companies that consistently will buy back their own shares, right? And they have within a year, they know, prices go up and down. When the prices come a little bit down, they're undervalued. They're like, you know what, we're going to buy back our own shares. So the number of shares outstanding gets reduced, right? They're buying them in the open market. They're not going to come after the shares that you own. You're fine. If you have them, you're good. They're buying them on the open market. And what that does is because the number of shares gets reduced, and just based on supply and demand, the stock price over time, we'll see that it lifts the stock price up a little bit. Not by a whole lot, but a little bit, and it comes up again. And so that's what we're looking for as investors. We're not just focused, even though the primary focus is dividends, the dividend income, but it's nice to have the capital appreciation as well over time. And so this just supports that, and it helps us to benefit from that as well.
Yeah, that's a really good one. I like that. Let's move on to rule number 11, valuation metrics. Is the stock priced low, undervalued? Yeah, I think this is perfect at rule number. I'm just trying to think of would I put rule number 11 or rule number 12, but no, I think you have this laid out in the right step. Rule is a stock priced low, undervalued. Let's talk about that.
Yeah, so this is a big one. And here's a
Yes.
shortcut hack for everybody listening. I come straight to rule number 11B. And I'll talk about A, B, and C. There's three parts to it. But you just come straight to rule number 11B. If the company doesn't pass rule number 11B, you can skip the rest of the rules. You don't need to worry about anything else. Because what's important is for us is that we're buying the stock. It's a quality stock, that's number one, but the stock is undervalued, right? Prices go up and down all the time. And we want to buy it when it is historically undervalued. And a lot of the quality companies, they're undervalued. They become undervalued not because they're mismanaged, not because they have too much debt, not because the payout ratio is crazy, right? Not because they cut the dividend, because we've already covered all that in the previous rules. But sometimes it's because, a politician is going to say something on TV tomorrow that's going to
Yeah.
drag the markets down, right? Or just the industry itself, right? Could be the retail industry. One other company, a competitor did something bad or whatever, it dragged all of the retail stocks down. For some reason or another, quality companies will become undervalued at some point. Then they go back up again. Then they come down and they go up again. And so we want to buy them when they're undervalued. So how do we know when a stock is undervalued? So that's rule number 11A, B, and C. So rule number 11A is we're looking at the PE ratio. So for us, we want to see a PE ratio of 25 or less. That's going to tell me that the stock is reasonably priced versus a company that has a PE of 800 or 900. And there are stocks out there today that have PE in the triple digits.
Yeah.
So rule number 11B is where we look at the current dividend yield and we compare it to the company's average 20-year dividend yield. So if the current yield is higher than its average 20-year yield, then we consider the stock to be priced low. It's historically low, right? And I'm going to move on to 11C. For each of these, we can spend easily 20, 30 minutes on each of these, but I'll move on to rule number 11C.
Come on again, buddy. We'll dissect it. I'd love to. Yeah.
So that we can go through, like I said, it would take a little longer. But rule number 11C is now we're looking at the price to book value, right? The book value is how much is the company worth if they were to liquidate it today. So if we take a company like, I don't know, Walmart, they own a lot of real estate, they own a lot of buildings, they own computers, office equipment, desks. If the company went bankrupt tomorrow, we sold everything that they had, we paid off all of their liabilities, you would end up with book value, right? So we look at the price to book value, we look for 3 or less. That's going to tell us that a company is historically priced low. So we don't want to overpay for stocks.
Those are all great. I literally have nothing to add to that. We're talking a little bit about Kelly Wright a bit, another value investor. Is that what he used? I can't remember. Yeah, current dividend yield must be higher than 20-year average dividend yield. They're the same sort of system and rules. Are you guys working off the same sort of framework? His is a little bit different. Yeah.
Yeah, it is. It is. Geraldine Weiss, who was the founder of IQT, where Kelly Wright is from, she's written a book about this, what covers all of the science behind it. So yes, absolutely.
Okay. I want to move to rule number 12, and then I'm going to run something by you, and I'd like you to just break it down. Okay, so rule number 12, rule number 11 and 12. These are just like this is how I make money. Rule number 11 and 12, and then emotional discipline. Keep your emotions out of investing. Discipline and patience are key to successful investing. Let's talk about that.
Yeah, absolutely. So number one, you got to have patience because the stock markets go up and down. We are going to have other recessions in the future. We are going to have market downturns in the future. The key is not to panic. When you panic and you sell when the prices are low, you've now solidified your losses, right? So we don't want to do that. As dividend investors, we have the advantage of we're getting paid while we hold on to our shares. So the share price could go up, it could go down even lower, it can go up again, it can go down again. We're going to get our dividends, right? Because we're looking at companies that have been paying dividends. I'm looking here at Coca-Cola has been paying a dividend since 1893, right? The Bank of Montreal, since the 1800s, they've been paying dividends. So they've been around for a very long time. So we're getting paid for holding on to our shares. So have the patience to ride out the market downturns, right? Don't panic. And then the discipline is to stick to the 12 rules. I don't want people making exceptions for themselves, saying, you fall in love with a company and you're like, well, I'm going to ignore rule number 5 and I'm going to ignore rule number 7 and I'm going to go ahead and buy it now. No, don't do that. Have the discipline to stick to this approach. Also have the discipline not to jump around to different things. So you can't be like, I'm a day trader this week, and next week I'm going to jump into crypto, and next week I'm going to be a value investor, and then after that I'm going to do something else. It doesn't work that way. We are long-term investors. Warren Buffett, Charlie Munger have talked about this for decades and decades. Stick to the approach. We're looking at the fundamentals. If you've done your homework with the 12 rules, you're looking at a quality company that's now priced low. And then you can feel confident in investing in that. And there's no guarantees in life, right? I'm telling you right now, and same with the audience, because I've been doing it for almost 3 decades now, you are going to have, even when you've done all the homework, and Kelly Wright says the same thing, even after you've done all the homework, you will have over your investing lifetime 1, 2, or 2 or 3 losers, where you've done everything you did everything right, and the stock still tanked. GE is a good example, right? It never recovered, right? But what do? Because we've invested in quality stocks, because the majority of those companies continue to increase dividends, and we diversify across different industries and sectors, we're going to be fine. I've been doing it for 25 years. Every year, my dividend income has gone up. And that includes 9/11, 2008, 2009 financial crisis, COVID, and the dividend income generated from the portfolio has gone up. The value of the portfolio has gone up and down, because that can change. It can change tomorrow. I don't know. The markets could open tomorrow down 2%, 5%. But it's the dividend income. We want that reliable income that continues to grow. So don't fall in love with companies. Just have the patience and discipline to stick to the approach.
Over a 20-year period, though, does the value of your portfolio go up, not just the dividends? Or is it still up and down? Yeah. Okay. Short term, you see those swings, like maybe in like a year or something crazy. But overall, okay, so you're a dividend investor. Now I'm going to start talking about the differences between me and you. How are we different? So I wouldn't call myself a dividend investor. I don't look at dividend as the first primary mover of what I'm looking for. I'm, I guess, purely growth. I'm just like, I want to take that number from $1 to $5 and then eventually sell, or maybe I'll keep holding, but my holding patterns are 6 months, a year, 5 years, 10 years or more. So it does still break into different things, but that's sort of how I work. I'd say the majority of my portfolio is stuff that I've been holding for 5, 10 years, but there's stuff I will flip in 6 months, a year, stuff like that. I will do that, but with the intention of that's kind of what I'm going to do with it. Now, I follow most of your rules though. Like these rules I feel still apply to most investing methods, even though I'm not a dividend. Like rule number 1, business understanding. Do you understand how the company's making money right off the bat? Yes. Like that's like, I've talked a bit about that on my channel. Rule number 2, long-term viability. Even if I'm going to sell a company that's saying 6 months, I don't buy it unless I think it'll exist in 20 years from now. I still actually don't go near it unless I go, it's got to meet this criteria. Competitive advantage. Even if I'm going to flip it in 6 months, right? I still come at everything with, does it have a competitive moat? Does it have a huge competitive advantage? I will not buy it if it does not have that. Recession resilience, same exact thing. Consistent profitability, same exact thing. The EPS, the dividend growth history. I don't really look at dividend growth history. That's something that Kelly got me sort of more thinking about. Payout ratio management, debt management, dividend stability. I think dividend stability is something I don't really look at, but it's something now I'm actually more aware of a few things after just speaking to you now. I'd be like, oh, I'm going to equate, even if I'm a dividend investor, I'm going to hold them accountable to all this criteria. But if it's in a tech stock, they're not really dividend heavy, right? There's next to none on it. So there's only so much I can do here. Share buyback activities, that's something I look at extensively as well. And then valuation metrics, is the stock price low, undervalued? Okay, so typically what happens is I go through majority of your list, the growth investor, who's going to flip it in 6 months, a year, 5 years, 10 years, or who knows, 30 years. So something, I have a couple of Coca-Colas myself, like things that I just will hold forever. But then I go, is the stock price low, undervalued? I will create a list of companies that meet your rules, right? But they haven't quite hit the rule number 11 yet. they're still equally valued or overvalued. And then I apply, this is where we're different. Then I apply rule number 12, emotional discipline. Then I sit and I wait. And I just wait for what you mentioned before, negative sentiment to occur, not actual fundamental problems with the company. I wait for someone to say something crazy, the stock to plummet 40%. And then I go, there's my new entry point. And that's what I do. And then I have a video coming out and I'll talk about this. And I'm going to really condense my rules. I use all your stuff, most of your stuff. And then I have a 3-step system. And the video will be out. People search, I just sold X amount of money, X amount of stocks. Am I an idiot or something? It'll be something along that lines. But I did sell a lot, a few hundred thousand, quite a few $100,000 worth of stocks I've consolidated over the last couple of months. Step number 1, I hoard cash. So I get a ton of capital together, right? Rule number 2, I do your steps plus a few of my steps, right? I add them to my crash list. Rule number 3, I wait months and years before buying anything. And I just sit around like a dragon on my pot of gold and I wait. And I just wait and I wait. And I don't even touch anything at a minimum unless it's crashed 40%. I don't even go near it. I go, ooh, 20% crash. That's nice. Is that like I bought Facebook when it crashed like 80%? Like I wait for things to completely destroy. But I bought Facebook because I'm in advertising and I understood the fundamentals and I understand that they're profitable. I understand it was all negative sentiment. I knew Facebook almost as good as Zuckerberg. That's kind of how I go. And I just sit and wait. And then I hold or I sell them. An example of a short-term sell, and this is different than you, is Tesla in April crashed. I bought it and then I sold it like 6 weeks later at a 56% or something increase, only because I knew enough about Tesla, but I didn't care about them. I wanted off it really bad. I just hate the fact it's so volatile. And I sold it, and that's a short-term trade. I rarely do those, and I won't be doing this with my stockpile of cash. My stockpile of cash will be very much in the I'm willing to sit there for months to years to find the opportunity, and I'm also willing to take psychologically the hit of watching that money get hit by inflation. I'm waiting. I'm sitting it. I'm doing nothing with it. I have to consolidate stocks, some shares in Nvidia, some in Google, stocks that will go up in the interim where I could be losing tens, even $100,000, but I just want to sell now. I sold them when they're hitting all-time highs. I sold them just because maybe when I need that money and I'm trying to sell during a market crash, they'll be valued so low, I won't get what I need to get. So I'd rather psychologically have that money sitting there so I can only focus on the steps, the rules, research. And then I have one less distraction. So psychologically, I made that. It might not work for everybody. It might be crazy, like, oh my God, I could have held it. For me, I'm like, no, I just want to know I have the money there so I can only focus on one thing, research for the next few years until I find a list of winners. And when they start crashing, if they crash, it could take years, I start buying and I have a whole pot on top of that, I have tax sheltered accounts that are already maxed out I do index fund investing like ETF stuff. That's just going to sit there and keep making money and I can use them in retirement. So it's not like I have my investment portfolio is already maxed out. This is like another thing. What did you think about everything I just did? Is it disgusting to hear someone operates that way? Does it make any sense? Or does it just go against everything that you do?
Yeah, no, I think it's what I tell people at the end of the day, it's your money, right? And you decide where you want to invest it, how you want that money to grow. So if this is something that's working for you, that's great, right? And you've done it for a while. So you should keep doing it. If it's working for you, that's great. What I tell and for most people, because this approach, what you're doing requires a little bit more time and effort because you have to research this. The example with Tesla, you would have to know, okay, now I'm going to buy it, keep an eye on it every day, every week. Okay, now I'm going to sell it. So that requires a lot of monitoring and keeping an eye on things. So that requires a bit more work. My audience is they're a little older. They've got kids, they're married, and so they have day jobs, and they don't have a lot of time to put in to researching stocks. And I think you and I mean, we can talk about this stuff for hours, and I think we enjoy doing this. Most people don't want to do that. They don't want to look at stocks. They don't want to look at companies, even the 12 rules. They don't want to do any of that. They should do the 12
rules. I honestly think everyone, you should, if you're going to buy a single stock, you need to do the 12 at this point. Like I'm reading through this and I have a lot of dividend investors on the channel. Don't do what I'm doing. Like I do, what I just explained to you is a sickening amount of work.
Mm.
That's why it takes months to years. It's even build a list and then you just have to sit around and wait. But the 12 rules, I feel like why shouldn't you? If you're going to put real money down, you can't mess around with that. Like if 5 grand, 10 grand, 20 grand, 50 grand, 100 grand on a stock, just at least go through the rule. At least you've dramatically decreased your chances of this going sideways. Because, it's a lot, the probability is much higher if they don't use your rules, is what I'm saying. And that's harder in money.
Yeah, absolutely. So yeah, what I meant was they know they have to follow the rules. They just don't want to have to go through them one by one. And so,
Yeah.
we have a web application. I spent 3 years building it, so it kind of goes through all that and it does that with the U.S. and Canadian stocks. But what I was going to say is, I do have customers, clients, students who will come and say, you know what, this is great, but I have friends who just tripled their money on Nvidia, and I just want to do the same thing. And I just want to put all my money in there because I can make a lot of money in a short amount of time really quick. And so here's what I tell those kinds of people, okay? Your primary focus, your primary goal, first and foremost, should be to build a solid financial foundation for yourself and your family. Because if something happens to you or something happens to your spouse, are your kids going to be taken care of? Is there enough money there? Or if there's an illness and you can't work anymore, is there enough money in there that you can maintain your existing lifestyle and cover your expenses? And without dividends, you're only hoping for the stock price to keep going up. And hope is not going to cover your expenses. The dividends can, because it's cash coming in, right? So build that solid foundation first. And then if you want, and you want to spend money on, high growth stocks, IPOs, crypto, or anything else, then take a small portion and, you go ahead and try it. Just do your homework before you do that.
I'm going to jump into that in a second. A lot of the stuff you're mentioning, though, like I'm looking at your website right now, simplyinvesting.com, guys. It's in the description. You'll see the link in the description. You also see the link in the comment as well. The app is there. There's a dividend course. You've also got a podcast. So there's a bunch of stuff there. So let's go to simplyinvesting.com. So there's a lot of resources there. So check it out. Okay, let's go. Let's talk now. We've gone through the list of 12 things, guys, to follow the list. Now we're just going to be talking, sharing philosophies on this. Okay, so we agree on that. So you have a family to take care of, you have stuff, you need a foundation. I have this stock picking thing because I have a foundation set up. I've already have a large portfolio. I'm an ETF investor, not a dividend investor, growth focused. For now, I'll probably convert to dividend as I get older, only because I didn't really think about that when I started. I was just kind of like, I just want growth, but I still went super safe, right? I bought a VFV, a VOO. Like I went the most boring strategy possible, being like, I can probably calculate what that'll look like in 30 years, right? So I still took it the most boring way possible, which is before you invest, do one of the two. Boring dividend stock picking, like you, or boring ETF stock picking, like me. Max out those tax sheltered accounts so you have peace of mind that everyone's good. Where it's set up, you got a minimum 100K you built it up to in your tax shelter account today, and you're just letting that thing compound. Like that's before you even think about doing anything crazy that I say. That's why I'm able to do what I do. But now talking to your person who said, I bought Nvidia and I didn't buy Nvidia when it was exploding. Wanna know why? Didn't understand why it was exploding so fast. I was like, why is this coming out of nowhere? Why is it right? Like, I just didn't get it. Like it was not computing. So I didn't jump on the bandwagon of it. I missed it. I bought it afterwards when I was like, all right, cool. It's set. Like I started figuring it out, but it wasn't even that large of my portfolio because it still was like, now it just feels like super overvalued. So that's another thing. So one thing when I do individual stock picking is I try to, the best of my ability, remove the ability to get surprised. So if I make money off a stock, I go, oh, that's crazy, I made money. It should never be that. It should be, I am entering at this point, I'm going to exit at this point. Like I pick a number to exit at. And I go, and I think it'll take this long through just sort of like my assessment. And I go, it should take about this long. And then if it moves in any direction this much, I sell it at this loss. And I equate that all in there and I go, and then I don't deviate. I just go, and that's just what I stick to. And I go, hey, that's the plan for that. And I allocate money. And it's full transparency about where I get 80 something percent of my returns in my portfolio. And I built up that 7-figure portfolio using this strategy. So it's just what I do. So, but I'm in advertising. I do a lot of testing. I'm constantly just looking at data and analytics. It's like all I do all day. And I work in capital markets. So like I have the time. I'm timing things. I'm mapping them out. This is all I'm doing all day. I have my pulse on it. So I would never recommend it to anybody, but I would never be like, oh, someone made 3-4 return on NVIDIA. I should go buy it. That's just like, no, that feels crazy to me. It should be like, no, I slaved away. I did a bunch of research on this company. And then after that research, I decided it wasn't a good buy. Or I did a bunch of research on this company, wasted 40, 50 hours obsessing about it, put it all together. And then I just waited for it to crash. And there's still companies I've been waiting for like 6 years. Nothing's happened. There's on a list. If it ever meets its criteria, it constitutes a crash, then I'll buy. Like that's what it really looks like. It's still boring is what I'm cutting out to. Everything is boring. I put when I do invest and I buy that stock, it's exciting for that moment, but now it's got to follow that boring calculation of when I sell. All the research is boring. The ETF in the tax-free saving, boring. 12-step rules, boring. If it doesn't feel boring, I feel like that's a good sign that you're doing something wrong.
That's a good way to put it. I like that. Yeah.
That's all I got. That was my tangent. That's like a good, like, right? Whenever, like, because like whenever I see people getting excited, like I feel like they're getting put into a get rich quick scheme, and then that's when you hear those stories of, oh, like here, and I'm talking a bit much, but I think people relate to this. The reason why I didn't get into investing for a long time growing up was because everyone knew that person who invested in the stock market and lost all their money, and then your parents were like, "Ooh, that's gambling," and there's this stigma attached to it. And it wasn't until I got older and I realized, wait a second, this is not even close to that. This is the only way to protect against inflation. That's why I got into it, was to protect my money against inflation, not to make money, to protect it against inflation. I was like, this is the only way to do that. Then it opened my eyes. But those stories come from a really real place. It's people who just follow fad marketing, like those are rule. Like if you follow those rules, those stories will become less and less often. But I want to hear your thoughts on where do you think we are as a society when it comes to social media and pumping out, and you're a financial educator. So, but you give pragmatic, reasonable advice in a sea of clickbait, TikTok, 30-second videos of buy this stock. Where do you think that education is at? Do you think there's more of that stuff than there is of like the quality educational content? Give your commentary on that. I want to hear that.
Yeah, there's, in my opinion, there's a lot of noise out there, too much noise. There's a lot of folks who, I think myself as an educator, like I'm always, if you watch any of the podcast episodes, I'm always teaching. Everything is about teaching first. And I think there's very few of us out there that are doing that and just teaching and educating folks. There's a lot of people that make money off of, I guess, ads, TikTok. I'm not on TikTok, so I don't know how those ads work and how the ad revenue is going to work there. But a lot of people do it for that, right? In the clickbait and try to sensationalize the headings and the topic. So people are going to click on and watch it, and then that's how they get paid, right? They make their money that way. So there is a lot of noise out there. And even what makes it worse are the companies that are pushing financial products that may not be good for everybody, right? And they are backed by millions of dollars in marketing and advertising. And so that also is challenging for somebody like me to get the education out first. There's just too much noise out there.
That companies pushing products, that got me immediately thinking about covered call ETFs. I feel like that goes against everything you just talked about because there's tons of NAV erosion there. There's nothing. I own, by the way, I can say this. I have $100,000 in covered call ETFs just as an experiment on my channel. So I'm dumping, but it goes it's painful for me sometimes we running this test because it's like, it goes against everything. I'm like watching NAV decline. It's you're getting a return of capital. There's like a lot of weird stuff happening which I'm not used to because I'm used to everything just being like very black and white. Company makes money, dividends gets released. Like company does like there's like a lot of other stuff happening where they have like 25% leverage and all these weird little things happening to keep that yield high and give you your monthly income. It's like how much of it is income, and I'm trying my best to be transparent on what's happening because I'm not a covered call guy foremost. I try to get the pros and cons. I try to go like who this is not good for, who it is good for, and being like, this is agitating me, but it is cool to see money, but I know it's not real money because it's coming from the here, here, here. Like I'm trying my best. Um, how do you feel about it? Do you see a place for covered calls? I already know you probably don't like them because, but talk about the cons. And can you think of any pros and who do you think it'd be good for? My brain is like, it's good for retirees who want immediate cash. That's who it's good for. But examples of the cons and can you think of pros as a value investor?
That's a really good question. I'm probably not the best person to answer it.
You're the best.
I don't do it. I don't get
Yeah.
involved in any of those, only because it is the more complicated it becomes. I think the more it's a little more riskier, right? Because it's covered calls. Now you're getting into options, and they're doing everything they can to keep the yield high, right?
Yeah.
Like you said, the NAV is the net asset value is dropping. Um, I'm trying to be politically correct.
I'll tell you. No, yeah, no, don't be political. Please don't be politically correct because there's no room for political correctness on this podcast. Just say what's on your mind. I'll tell you what bothers me about it. And remember, I have a guy who have a lot of money in this, and I'm continuing to build it up. So I'm just being forthcoming because it's only educational if people see what's bothering me. I can't just say it's all great. I'm so used to being able to project stuff out. I'm so used to being able to calculate long-term value. I can't calculate any long-term value on any of the covered calls I own. I don't know if they'll exist in their certain state 6 months from now, or they'll erode into nothing, or they'll like, and none of it feels sustainable is what scares me. It all feels like we have this much gasoline and we're going 100 miles an hour, and that tank is like, I feel it, and I feel it, and I have a better understanding of it because I'm so entrenched in it than most people. And I have that feeling. I had a weary feeling before I understood it. Like weird, like, what is this? Sounds too good to be true. Started doing it. Like, oh, this is kind of nice. Oh, there's a lot of downsides. I see the upside. Still don't trust this. I'm a YouTuber. This will make for good content. I don't want you to waste your money. Let me waste my money and figure out what's happening here. So I've been very forthcoming and saying, hey, don't buy what I buy. Can you watch me lose my money instead? Let's figure out how this actually works over the long term. Because I'm not sure. And I have a marketing background, like I mentioned before. I'm testing. This is a testing phase. I can't recommend anything until I have enough data. And, I own some covered calls that have data of, it came out in July 2025. So as of filming this podcast, I released a video today. So this will be 2 weeks from now. But you'll see one thing, you'll see an episode on my channel. If you go check it out after it's called, I just spent $1,000 buying 6 covered call ETFs. 2 of them were Daymax ETFs, which pay you out every 2 weeks. And the other one were single stock covered call ETFs, which is like Tesla, Nvidia, stuff like that. Like, I can't imagine myself holding those 5 years from now. I just feel like they would like, what are they going to be? Erode into nothingness? Like, I don't, if I never, okay, I got to stop because people don't want to hear me talk this much. My thing is, if I feel like if I don't keep putting my earnings back into them, keep buying back and feeding back into it, it'll disintegrate into nothing. So I'm never truly getting income because I have to keep reinvesting it rather than taking something with a much lower yield, capital appreciation, which I could not reinvest it and it would still over time increase. It was a long-winded way of saying that's what bothers me about them. Jesus Christ. That was the longest way I could, because I'm thinking through this. That is the fundamental thing that bothers me. Is that a rational way of me bothering me, or am I just not accepting what I'm dealing with? No, that is what you should expect. That is the game you're playing.
I agree with you. I agree with everything because I don't think I've looked at 2 of them last year because I had a client of mine email me and say, "What do you think?" And as I dug deeper, it doesn't look like I could be wrong, but in my opinion, it doesn't look like that they're going to be sustainable in the long term.
Okay.
And number 2, you're very brave.
I've become numb to money at this point, and it's from, like I said, years of advertising and working with massive budgets and years of investing and moving around so much money. If it's doing something, the numbers are doing something, I don't really get bothered by it because I factor everything in. It bothers me buying $20 worth of McDonald's because it disintegrates into nothing. But if I'm moving it around and doing stuff like I don't know, maybe because I feel more control, maybe because there's numbers on the screen, it doesn't hurt me. I don't know. I don't know what it is. I'm broken. But okay, at this point, I really gotta not talk too much because you are the guest, and people do not want to hear me talk this much. But I'm just trying to set up some stuff for this conversation because I need to hear your thoughts on this. How crazy am I? Okay, so this is where I'm going because you're a value investor. You are the most pragmatic of. They call you value investors, right? That's the correct terminology for your type. Like I pretend like you're a species, like a weird species.
So I actually refer to myself as a dividend value investor.
Okay, sorry, I got the wrong what acronym of dividend value investor. Sorry, I am now. Here's how I'm breaking it up, and like I said, everyone has different investment strategies, but I'm thinking I have such a concrete portfolio in ETFs, and that's what I'm comfortable with. It's what I like. I like just knowing. I feel like I have room in my portfolio for a crazy supercharged high yield dividend thing that I keep reinvesting into. And if one day I don't want to reinvest money into it and just collect that income for a month and take my family to whatever, Europe for 2 weeks and blow through $15,000, I'll just turn off the drip, take that money, go crazy, then turn it back on. It might be that place that I just allocate to crazy stuff. It's that crazy part of my, if it goes to nothing, I don't care. I have a foundation. If it does something, I'm fine. So now I have boring investing that I won't even see the money from till I retire. I have short-term supercharged money that if I ever want to, I can live my life to the best and just turn on and off as I see for the next 30 years, but keep reinvesting into it so it doesn't just erode to nothing, right? Just keep putting it, but when I want to turn on, turn it back on. And then my third tier is what I really make my money off is picking single individual stocks that I sell in, realistically, I do like 5 years. That's like the number I typically flip things, 5 years, 10 years. In those kind of things. And those are the ones that just give me huge increases. But even at the same time, that money gets reinvested into other stuff. I never see it. So this would be my way of, in the next 20 years, actually playing with the money I'm investing and having fun with it and spending it on life rather than the other two forms, which I never really see, that are going to my kids that are going to use in retirement. And it's like a three, they always say have 3 pillars. It would be my 3 pillars. It would be the smallest pillar, but it's a nice pillar where maybe psychologically I now feel balanced. I get immediate reward from this covered call strategy. I get long-term full reward from ETFs and medium-term return reward from those single stocks. Is there some logic behind that, or that's still stupid and I should just dividend value invest and just build that portion of my portfolio?
I'm going to give you the short answer, and I'm not going to sugarcoat it because I'm too old to sugarcoat things now.
Yeah.
I know people are going to leave comments, but I'm okay with that. I get them on my podcast as well.
Yeah.
So I don't. The covered calls we already talked about. I don't see a future in that. So I wouldn't invest in it myself. ETFs, same thing. Sorry, same thing, meaning I wouldn't invest in ETF. There is a future. They will be around for a long time because they're just basically what they're doing is they're investing in stocks. The issue I have with mutual funds, index funds, and ETFs is the same thing. The issue I have is when you're buying into any of those 3 things, at any given point in time, today, if I was to put in $10,000, $20,000 into an ETF, not every stock today in that index is undervalued. Some of them are overvalued today, right? Because if I buy a S&P 500 ETF, some of those stocks have a payout ratio of over 100%. Some of them have a debt level of 200, 300, 400%. So if I wouldn't individually buy those companies, why would I buy them inside of an ETF? So that's just my non-sugarcoating answer.
And then what about the single stock strategy that I have? That's 1, 2, and I have my third pillar.
Yeah, so I think that's going to give you the best growth with the least amount of volatility and the least amount of risk.
It is all my growth. It is, like I said, over 80% of my growth. Okay, back to the ETFs. Now here, I ran into this problem with Kelly, and guys, we keep mentioning Kelly, right? You're going to see a podcast with him eventually. To frame a reference, I was telling him off camera, I did a podcast with him, but the video was messed up, so it didn't get aired, so you'll see it later. So anyways, the same thing. He said the exact same thing, but here was my response to that. ETFs I buy during crashes as well. I bought like VFE and all them during COVID. I didn't really buy a whole lot of them until the April crash again. I actually didn't buy anything the whole 2024 because I was like, what's going on here? This is just like going like this, and then like I was like, I'm not gonna keep buying, and I bought it on a giant dip again. I'm like, okay, so I tend to just load up on it whenever I see like large crashes, and then I just buy in, and then I go, that's kind of a way for me to make sure I'm getting those companies when they're possibly undervalued. So that's sort of what I do it. And it's just that's kind of my approach. And then my advice to people is like, if you don't want to time, and like I time it out because I'm looking at the markets every day just for because work and everything. But if you don't dollar cost average into it, maybe you'll kind of capture some of that. It'll stop you from at least doing what I did one year, which was at the where I bought it at an all-time high, like my TFSA. It's like, and then it crashed. And I was like, oh crap. And then like I stopped doing that. Now it's just like, if I'm going to do it, I'll dollar cost average. But for the most part now, I'm not in a rush to purchase it anymore. It's like, oh cool. If I see like a large dip, I'll buy it. It just, I have, and it's already like, it's large enough, that position where I can kind of just let it do its thing now. And then, yeah, like I said, buy it on dips and stuff. So if someone's only buying during dips, uh, noticeable dips, does that help, in your opinion, alleviate or have it make a little bit more sense?
It helps a
Or
little bit.
still,
It
you know,
helps a little bit, but the other thing that's going to get you in the long term is going to be the fees. I know the fees are much lower with ETFs. Mutual
yeah,
funds have a
2% or
2.2% average fee. Index funds are like 1%, and then the ETFs are lower than 1%.
like 0.06 or something.
Sure, yeah, anywhere from, I've seen ETFs with 0.05 to like
Yeah.
0.03. So anywhere in between the fees. Now, in the beginning, the fees don't seem like a lot. They seem like they're insignificant. If you're putting in 5,000, 10,000, 20,000, $80,000 in an ETF, and you're only going to hold it for 2, 3, 4, 5 years, the fees are going to seem insignificant. Where it's going to get you is once you get into like $500,000 in your RSP or TFSA, or combine both of those accounts, $800,000, $900,000 sitting in an ETF. I don't have the numbers I have in front of me is only for a 0.5%, but proportionally, I guess it'll go down. But even with a 0.5% fee, after $500,000 invested, and you don't put any more money into that account, which most people do because they invest regularly in their RSP or
Mm-hmm.
TFSA. But if you stop today, after 20 years, you're looking at over $200,000 lost to fees. After
Yeah.
30 years, that's over $650,000. And after 40
Yeah.
years, which is your lifetime, it's over 1.8 million. I would rather keep that money, you keep it for yourself and invest it elsewhere.
Do you think there's baby steps people can take to go from knowing nothing to investing to using your 12 steps? Like everyone starts with mutual funds when they first started. Then they go, wait a second, paying 2% in fees, this ETF thing. Okay, great. I'm doing 0.5, 0.6. Great. Wait a second, there's 12 steps. I know enough. I'm just gonna do this and remove it all together. Is that how it works? Is that the education process? Because like I said before, I'm making all my money by picking stocks, but I still have ETFs. But I started in ETFs too. And I did, but no, I went mutual funds, ETFs, then stocks. I went boom, boom, boom. Except I didn't go into dividend value investing. I did my own weird little thing that I do, but same exact thing. Is that the natural maturity process as an investor that people that have
It
growth?
is. It is because I started with GICs, which are term deposits.
Oh, oh yeah, yeah,
I started with GICs, then mutual funds, then index funds, then ETFs, then individual stocks. Yes,
yeah.
that's a natural progression. What I'm here to tell you and the audience, and what I've made my mission in life, is to help people skip those steps in between with
Yeah.
education and making it simple that you can just go right there. The other thing we haven't talked about, and I just want to mention very quickly, because I know you're in Canada as well, I'm in Canada. Canadian dividends are treated very well when it comes from a tax perspective, right?
Yeah.
So think about this, you're retired, you're 65, no other source of income outside of your TFSA and outside of your RSP. In British Columbia, you can make $65,000 a year and pay zero income tax on that. 65,000 in Canadian eligible dividends. So companies like BCE, Canadian Tire, Bank of Montreal, those kinds of companies. And with a spouse, you're looking at $130,000 in eligible Canadian dividends each year, zero income tax. So that's huge. especially for later on in life. That's
Yeah,
going
I
to vary
think
depending on which province you're in, but I just wanted to give that as an example.
that's a good thing, especially for people who retire where their portfolio is large enough to pay out that level of dividends yearly. That would make more sense. Um, when you're looking at capital growth or like actually yearly returns, not dividends, how does a portfolio like yours compare against a VFV and S&P 500? Are you comparable to average annual growth without the fee attached? I was
Yes.
talking to, yeah, like it looks,
Yeah.
well, from what I've seen in the past, it looks similar.
Yes. It looks similar, right? I'm
Yeah.
completely transparent. I'm not making 50, 80% a year. I'm not making
Yeah.
200% a year. No, it's the average stock market return over the last 100 years is going to be anywhere from 8 to 12%, right?
Yeah.
So where I'm making that minus the fee, right? So that comes in handy. The other thing is I have control over those investments. I can decide when to sell, and what to keep, what to buy. And I'm very selective in just looking at quality stocks. I just don't want to buy everything.
W- After you've done your 12 rules, because I'm just thinking here, when someone buys an ETF, the one of the major factors of it is it's set it and forget it for the most part. I think that's what appealed to me. I was willing to just pay the fee to be like, I just kind of don't want to think about this. So I can go, like I said, I'm hoarding cash, so I don't have to think about capital being set aside, even though I'm taking a loss. I'm like, I just want to know it's there. Sometimes I just don't like to think, so I can focus on the other thing. So that's a big part of someone buying a VAV or an ETF. It's like I can set it, forget it, and go live my life. After they go through the 12 rules, because there's some time there to make sure they meet the criteria, what is that upkeep, yearly upkeep, when you've got your portfolio dialed in, you've got your, and give me an example of how many stocks would someone typically hold? How, if you have X amount of stocks in a well-rounded portfolio, it's been told me in the past, you try to have exposure in every sector to some degree if you're going to do it. Is that accurate? And then what does that yearly upkeep look like?
Yep. So those are all great questions. I'm going to just
Thank you.
repeat.
Thank you.
I'm going to repeat what you said, right? So I'm not against ETFs, right? And for that reason alone, if you are looking for something that you're going to set it and forget it, if you're not interested in learning on how to become a dividend value investor, if you don't have that inclination, no desire to learn, then a low cost, broad based ETF might be the way to go. Just know that you're going to be paying those fees over your lifetime. For an average Canadian over their lifetime, you're looking at close to $500,000 lost to fees, anywhere between $400,000 to $800,000. But that's life. If you want to set and forget it, that's the way to go. Okay, so now your question was how long does this take? So once it's all set up, I have the investing course, so that's about 3.5 hours. You go through the course, it's self-paced, and you learn the basics. In the first time you go through this exercise, it's going to take a little bit of time, an hour, 2 hours, the first time you do this, right? Because you're starting from scratch and you're picking selecting which dividend stocks to invest in. The web platform that we have makes it easy because it applies the SI criteria to 6,000 companies in the US and Canada every single day. So that makes it a lot easier. Afterwards, the upkeep, I would say you're looking at probably an hour to 2 hours a year. You can do it every
Yeah.
6 months. You can do an hour every 6 months if you want to. I look at it more often because I enjoy this and I'm passionate about this. But for most people, look at it every 6 months. Spend an hour every 6 months to see where you're at. Oh, and the number of stocks you were asking about, anywhere from 25 to 35. That's the average. Some people have more, some people have less. It's a lot easier to track nowadays with Excel and all the stuff. You can track all your holdings in there, but it's going to take you time to get there. You're not going to be able to build a well-diversified portfolio today or tomorrow. It took me 3 years to kind of go, because not everything is
That's not bad.
undervalued today, right? Not
Yeah.
every utility stock is undervalued today. So you're going to buy what's undervalued today. The next time you invest again in 6 months or in a year, then you look at what's undervalued then.
Do you publicly tell people what stocks you own? Do you put that
Um,
anywhere?
I have it on my I had it on the old website. We just upgraded the site, by the way, yesterday.
Looks nice. It looks nice.
The entire site's changed. Thank you. So if it's not there, I will be putting it up in next month. So what I put up there is because people want to know what the performance is, sort of the track record. So for next month, we'll be putting up a list of what I currently own.
Okay, so here's why I'm asking. I need you to help me here, my financial dividend investor friend. I'm now thinking of a couple things because, like I said, I have a YouTube channel. I'm basically adopting every investing strategy on the planet now, and I'm making content about it. And I feel like after talking to you, after talking to Kelly, first off, this is in line with how I think and invest. So this feels more natural. I feel less stressed out talking to you than I do when I'm talking about covered call investing. Like I get stressed, right? So I'm thinking of a couple things. First, you said your app allows people to segment that out, help search through the different investment opportunities, right? Okay.
Yeah.
So here's what I'm thinking. I'm gonna most likely do a couple things. Kelly also has a list of stocks he recommends. I'm gonna fuse you guys together to help my research. I'm gonna use his resource and your app to drill down and build myself a value dividend investing portfolio, right? I'm gonna do this. So people hearing this will see that video coming out in the next couple of weeks. I'm gonna put it in and tell me where I'm wrong or if this makes sense. 'Cause I'm not gonna do it unless you go like, okay, that kind of makes sense. If it doesn't, I'm just gonna leave it. So now I have you guys as a research tools because you guys are great at this. The app is gonna help a lot because I'm an app guy. Then I'm not gonna my TFSA, RSP, all that stuff is full. My corporate account, but I am putting money into my non-registered account. That's where I have my covered calls. Taxes. A lot of those covered calls they're not dividends, right? They're actual the return of capital and stuff. So they're being taxed completely different. So I wouldn't mind leveraging that Canadian tax benefit, which is massive in Canada, even though it's small, incremental. And then I'm looking for a long-term portfolio of my non-reg. Why don't I create a 4-pillar strategy where I have value dividend investing, covered call investing, single stock picking, my growth strategy, and then I have my ETFs, which I'm just going to keep doing that because I just like it. I'm fine with it. So if I build up a dividend value investing side of my non-registered account, focus solely on Canadian companies, and I earmark that as in 20 years, this thing might have some pretty healthy dividends that'll probably be in and around, it'll be under $65,000. So I just get this tax-free money. I don't need it now. If I want that supercharge, I got that crazy covered call thing going on. And that's how I can look at it. I can feel better about it because I know it's not going to explode overnight. It adds stability to my non-registered. It adds stability to my non-registered account is the main thing. And it's another thing I can look forward to in 20 years or so to start paying out some healthy dividends at that point. It'll start small, but I'll build it up over time. And maybe I can take some of that money from the covered call ETFs that's just eating away. And rather than reinvesting in the covered calls, put it back into the more stable value investing stocks that I picked and buy more shares of those, as long as they are still at that valuation where it's worth me buying. What do you think about that strategy? And then secondly, when I do buy a stock that rule number one, it hits of like, here's the entry time. Like, that's the entry point. You hit it. If that entry point changes in 6 months, do you just stop buying that stock and then move on to another one and add that to your portfolio? Or do you only ever buy them when they're at the right entry point, when they hit that number? That's all I have.
Yeah, I only buy them when they're undervalued, right?
Yeah.
So if I buy a stock today, it passes the 12 rules, it's undervalued, I'll invest in it. 6 months from now, I've got some more money, I've got more dividends to reinvest. I will look at what is undervalued and a quality company at that point in time in the future. So if it's the same company shows up again, I may buy it. Maybe I want to diversify, so I'll look at something else in another industry or another sector, and I'll look at it at that point in time. The example I gave you with British Columbia, $65,000 in eligible Canadian dividends, that was with assuming no other sources of income, right? So that was like somebody who's 65, who's quit their job and all that. If you're going to do this approach and you're still working and you're still making an income, you will get taxed on those eligible Canadian dividends, but the tax will be less than it would be, for example, on capital gains or on interest.
Yeah, I forgot what the percentage is, but on Canadian dividends, do not quote me, guys. I'm just gonna say it's like 15% or something, or something. It's like some,
Yeah,
but
no, but it's low.
but it's an, but it's a legitimate number that makes it worthwhile to get Canadian dividends, Canadian companies. I remember when I was breaking some down. I was looking at an American company with a higher yield and higher dividends comparing against a Canadian company. When you equate everything out, they came out kind of similar. So the Canadian one had lower yield, but they get that tax benefit, and they're a lot closer after that. But so what do you think about that? Like adding that into my non-registered as more of a something to reduce volatility in a non-registered account when you're thinking about dividends. It's like I've covered calls for volatility, immediate income, and I have the 12 rules approach to stock picking for reduced volatility and more stability. So when let's say I own HHIS by Harvest, let's say, and it's all tech stocks, when that inevitably something bad's gonna happen soon. I keep saying that. When that plummets and something bad happens, I'm not just traumatized because I know that my other half of my portfolio is those ones that are still growing, and I can ride out the wave. I don't know. What do you think about that?
Yeah.
It's not ideal. It's obviously you want me to do all of it your way. I'm just saying, if you're thinking of someone who's A, making YouTube content, needs something to talk about, and B, adding as much diversity and craziness and having almost every investing style, does it make sense to place it here considering my circumstances?
Sure. If you're going to do A and B, yes. But you had the first answer right. The first thing I was going to say is put it all in.
Why even in it? Right? Yeah. Yeah.
Why the rest of the extra research, the stress, all the monitoring and all that stuff?
I'll tell you it, but I'll tell you it is.
Well, that's good.
It's what made me a really good advertiser. I was obsessed with split testing and analytics. I love to see how things perform. And the funnest thing to get real-time analytics is stuff that's changing constantly and that's kind of volatile. So for me, as like a guy who likes that, it's fun for me and it gives me stuff to talk about on YouTube. It has purposes outside of just investing. It's serving so many different purposes. And it's why I keep looking for different investment styles and like I'm adopting them into my portfolio because I'm like, oh, I'm going to talk about that now because I love testing. And a lot of my content now has actually turned into just pure case studies. I'm doing this I'm doing value investing. Here's what happens. I'm doing cover call. Here's what happens. I'm doing ETF. Here's what happens. And you're just watching it. Except what makes it crazy is I play with large sums of money, which you go, oh, okay, now it's kind of exciting a little bit, but I assure you I'll be fine because, like I said, everything is set aside properly. So that's how I'd go about it. So if I'm going through your educational funnel, I can go to your app. I can use that as a resource. I can start drilling down into some stocks and figuring out where I want to go. You said it's 25 to 35 you land on. That feels like it can get pretty large pretty fast if you're, depending on how often you plan on investing, right? It can, since you're only buying in at the right entry points. Then you what else did you mention here? Then you said it's only a couple hours a year after you've sort of dialed in your portfolio, which can take a few years to kind of figure it out, which is, I think, natural. It takes a few years for any type of portfolio anyways to see what you settle into. So that's good as well. Do you have any, I'm just trying to think of anything that you think we might have missed here? Because I feel like if people follow these rules, they're pretty much golden for safe, reliable investing strategies that work for both dividends and just standard growth. Because like I said, I was doing almost all of these anyways. So it was kind of nice to see that that's the way to do it.
Yeah, no, I think we've had a great conversation. We covered a number of things. The only thing we left out, but it's going to be specific for Canadians, for example, holding U.S. stocks, right? So if you hold them in a TFSA or a non-registered account, there is a 15% withholding tax. If you hold in the RSP, then you're fine. You have to fill out a special form. I forget the number of it, but then you don't get the withholding tax. So if you want to hold U.S. stocks, the RSP trading account might be the best place. Otherwise, the Canadian stocks are fine in all three of those accounts, non-registered, TFSA, and RSP. Yeah, other than that, I think we covered.
That was fantastic.
Great conversation.
This was great. I think I'm successfully been converted into a 1/4 value dividend investor one quarter ETF, one quarter cover call, one quarter single stock picker. I'm officially confused into who I am as an investor. So this is perfect. I really appreciate it, Kanwal. I want you guys all to go to his website, simplyinvesting.com. I'm going to download the app right now, so I'll have that. Yeah, we'll chat more off camera. And thank you so much for joining us on the podcast.
All right. Thank you for having me. Enjoyed it.
Bye bye.